It's true that you can become a millionaire by investing your money, only if you follow the rules, but if you don't follow the rules of investing, then you may face huge losses. In this video, we will be telling you the 12 rules of investing that will make you a millionaire very easily. Don't miss the last rule, as it is very crucial for you to follow. Now let's start. 1. Prioritize investing strategies based on careful analysis. Individual investors have varying risk tolerances and objectives. Depending on the returns they get, their opinion of the investment may alter over time. It's impossible to know whether or not you'll have the same level of success with any given investing strategy unless you try it out for yourself. Investments should be made after careful consideration of the investor's specific requirements and aspirations. 2. Your assessment shouldn't be influenced by temporary changes. Some stock investments may be prone to short-term volatility. One has to keep the larger picture in mind. Growth in the world's leading markets has been rather steady. Day traders are concerned about price volatility, while long-term investors don't have to worry as much. Granted, the pandemic might cause worrisome short-term patterns, like the one in March-April of 2020. Stocks are at an all-time high, but patient investors are now seeing their returns. 3. Focus on possible outcomes rather than actual outcomes. How often have you seen the caveat, past performance is not a guarantee of future success? Just because it's true is the basic explanation. Despite the long-term upward trend of markets, individual equities and even mutual funds are subject to periodic ups and downs. Optimal choices now may not be optimal choices tomorrow. Your aim is long-term wealth creation, therefore you need to study current and projected trends, statistics, news, and insights to make sound decisions. Another option is to just install the Cube Wealth app and let it handle everything for you. The problem is that nobody can see into the future. The greatest long-term investing choices might be difficult to make without the assistance of a professional wealth coach or wealth advisor. This is their daily grind, and you just don't have the time to do as thorough an investigation and analysis as they do. Do press the subscribe button and also the like button if you want to know the best invest tricks. 4. Be open to diversity. Relying too much on a single investment might compromise future profits. The danger may potentially rise as a result. Therefore, increasing future wealth calls for a more diversified approach. It's possible that if you lose money on one investment, you'll make it up on another. Your investing portfolio should be diversified with an open mind according to your risk tolerance. 5. Do not deviate from your plan. Selecting the appropriate investment approach and maintaining it would be the most effective method of making payments to your future self. The frequency with which investors attempt to switch tactics rivals that of Wile E. Coyote's tumbles from a cliff. Your financial well-being may be jeopardized if you do this. Talk with your mentor to make small adjustments if there are worries, in both short-term and long-term. Always keep in mind that the correct tactic is the one that helps you reach your goals. 6. Beware of being misled by taxation. It's crucial to minimize your tax liability. However, it's possible that you'll value tax avoidance more than the creation of wealth. If you start planning early enough, you may reduce your tax burden and increase your net worth. 7. Watch your investment charges closely. Costs like expense ratios, entrance load, exit load, etc., may add up quickly and be a drag on returns, especially when investing over the long haul. Long-term commitments sometimes come with high fees that might cut into your earnings potential. You are accepting losses in the form of greater investment expenses. The expenses of your investments may add up quickly, so it's important to keep an eye on your portfolio. 8. Think about your future self. Every single investor ever will have some kind of remorse about their investment. Statements like "I should have invested in Amazon back in 2004" are typical. Or "I really should have invested more heavily in technology companies during the dot-com bubble." The primary source of anxiety is the potential for making poor financial choices or for failing to seize favorable possibilities. To say nothing of poor financial choices. Think carefully about your options before deciding to invest or not in any of them. Stay away from bad debt while you're at it. It's a major blunder with serious consequences. The money you use to repay your debts or EMIs now comes from your future self. This cash might be put aside to accrue more interest. 9. Put away whatever extra money you have. To begin, it's best to pay for little outlays using hard currency. You become more careful when you can really see your money go. Your cool mind can help you decide how to best put any extra cash you find yourself with at the end of the month into investments that will provide you the highest return over the longest period of time, such as blue chip stocks, equities, mutual funds, US stocks, etc. To cover future costs, you'll accumulate and generate additional money. 10. You shouldn't treat your investment plan like a sports squad. Successful investors are those who are able to separate their emotions from their decisions about where to put their money. Because your favorite World Cup match has nothing to do with investing. Mutual funds and stocks operate in different ways, and brand loyalty is no guarantee of financial success. Don't let your emotions influence your investing decisions, think logically instead. A person's financial well-being might suffer from an unhealthy attachment to a certain brand or corporation. After all, that's what you want to achieve with a long-term investment strategy. Cube Wealth is a free app you may use to research your financial future. 11. Talk to a financial advisor. The challenge of long-term investing is real. To better schedule your investments and sales, it may be beneficial to see a wealth coach. A wealth coach may even be able to comfort you that you needn't worry about your investments since they are in excellent hands. Making money doesn't work that way. Investment advice from Cube's wealth coaches is always open and honest. On the app, you will only find a curated selection of resources. 12. Hold your patience. This is one of the most crucial behavior one must have while he or she is investing the money. I have seen many investors losing their patience on seeing any loss. Don't get scared when you see your account going in minus. Just believe in yourself and in your investment. But remember to set a stop loss in each trade you take, or if you get into any risky investment, as I did with the cryptocurrencies. Having an emergency fund and earning enough money for living will help you overcome your fear of investing. Always maintain patience to see some profit in your portfolio. That's all for today. Now you know all the rules of investing that will make you rich in 2023. These rules are followed by Sir Warren Buffett, Jeff Bezos, and all the other millionaires. If you want to get rich, then start following these rules from today. You can earn money without any effort from investing. Choosing proper assets is also important in making money, but rules are the most crucial element. Press the subscribe button if you got to know something new from this video. Press the like button to keep us motivated. Share this video with everyone, including your friends and family members. Comment below if you are having any queries or suggestions. Thank you for watching the video till here.